The 2026 NBA All-Star Game in Los Angeles is being marketed to you as a celebration of basketball excellence. But that is a lie. What you are actually watching is the highest stakes corporate audition in sports history. With LeBron James, Stephen Curry, and Kevin Durant nearing the inevitable end of their careers, the league is facing a massive solvency risk regarding its new media valuation. The NBA has a $76 billion problem. How do you justify that price tag when the three faces on the poster retire? This video analyzes the specific succession plan the league is executing to protect its future revenue. We are going to break down the financial CEO scorecards of the three players handpicked to save the league's bottom line. To understand why this specific All-Star game matters so much, you have to look at the contract the NBA just signed. The league recently locked in a new 11-year media rights deal valued at approximately $76 billion. That averages out to nearly $7 billion annually, a staggering increase from the previous era. But the structure of this money has changed completely. The league has split its inventory among three massive partners. Disney and ESPN retained the A package with 80 games in the finals. NBC and Peacock bought back in for 100 games with a focus on broadcast reach. And Amazon Prime secured 66 games to dominate the streaming and playoff landscape. This diversification wasn't just a choice, it was a necessity born from the collapse of regional sports networks. For decades, the NBA relied on local cable subscriptions to drive revenue, but with the RSN model imploding and TNT exiting the picture, the monetization model has shifted from local cable retention to global streaming acquisition. The league effectively traded the stability of cable bundles for the infinite scale of digital reach. However, there is a massive flaw in this plan. We call it the old guard cliff. For the last decade, LeBron, Steph, and KD have driven between 60 and 70% of the league's national TV ratings and merchandise revenue. When the Warriors or Lakers play, viewership spikes. When they don't, it drops. Their departure creates a tangible valuation vacuum. The NBA has successfully sold its future rights to shareholders at Disney and Amazon based on the promise of growth, but they sold that promise while the old guard was still on the floor. The business problem is simple but terrifying. The NBA must convince these corporate partners that the product is worth a $76 billion investment without the proven commodities that built the league's modern popularity. If ratings crater the moment LeBron retires, that $76 billion deal starts looking like a bad asset. To solve this, the league isn't looking for one singular replacement. The next Jordan strategy is dead. Instead, they are building a diversified portfolio of assets. They need a succession plan that mitigates risk by spreading the stardom across different demographics, regions, and platforms. So who gets the keys to the kingdom? We can identify the frontrunners by using what we call the succession matrix. Imagine a scatterplot analysis. On the x-axis, we have social media reach, specifically Instagram followers and engagement rates, which drive the casual fan interest. On the y-axis, we have on-court efficiency, measured by PER, which drives the smart money and hardcore basketball engagement. By plotting the league's rising stars on this graph, we can see exactly who is undervalued and who the league is banking on. Three distinct assets have emerged, each serving a completely different function in the NBA's new business model. Asset A is the global unicorn, Victor Wembanyama. Wembanyama is the international growth play. The domestic US market is saturated. Everyone who is going to buy NBA League Pass in Ohio probably already has it. The growth is overseas. Wembanyama is the key to unlocking the European market in a way no player ever has. We are already seeing the ROI. His presence alone drove a 63% rating spike in his televised openers, and he is the primary driver for international League Pass subscriptions. Nike knows this. That's why their strategy with his GT Hustle line is so specific. They aren't marketing him as just another basketball player. They are positioning him as a tech-forward alien. This branding is designed to capture a European market that values innovation and futurism over the traditional American hooper culture. The KPIs for Wembanyama are massive. The league needs him to generate a consistent 20 to 30% viewership lift on Spurs games and secure 5 to 8 major global endorsements. If he hits those numbers, he justifies his valuation as the face of the league's global expansion. Asset B is the American heir, Anthony Edwards. If Wembanyama is the international play, Edwards is the domestic retention play. The NBA cannot afford to lose the American youth demographic, and Edwards has a stranglehold on them. He dominates meme culture. He has the charisma, the sound bites, and the highlight reel dunk package that feeds the TikTok algorithm. You can see his value in the merchandise numbers. He is currently sitting at 6 in jersey sales with massive year-over-year growth. He is the primary driver for the domestic NBC and Amazon viewership slots because he plays a style of basketball that translates perfectly to a casual Sunday afternoon audience. Adidas has bet their entire basketball future on him. Their $50 million extension and the launch of the AE1 shoe were calculated risks that paid off. With over 1 million units sold, the AE1 proved that Edwards is currently the only player capable of challenging Nike's signature dominance in the United States. He is the high-yield dividend stock, volatile, exciting, and paying out massive returns and immediate engagement. Asset C is the efficiency machine, Shai Gilgeous-Alexander. Then you have the smart money play. SetGA represents a shift toward the high-end, analytics-driven consumer. He doesn't have the alien physique of Wembanyama or the explosive volatility of Edwards. Instead, he has elite consistency. His high PER and relentless efficiency appeal to a different tier of sponsors, the luxury and lifestyle brands. SGA is the key to the Canadian capture. The NBA projects a 12% rise in international subscriptions, driven specifically by his appeal in Canada. He unlocks a G7 economy that has been historically undermonetized by the league, but his real value is in the crossover. Look at his endorsement portfolio. Skims, Canada Goose, Converse. This isn't about performance gear, it's about fashion. Converse has built the Shai Ogura One strategy around this, ignoring traditional on-court performance marketing to focus entirely on runway appeal. He positions the NBA not just as a sport, but as a lifestyle brand. When you look at the comparative analysis of their endorsement portfolios, the strategy becomes clear. Wembanyama is the long-term growth stock, high PE ratio, massive future upside. Edwards is the high-yield dividend, delivering cash flow right now through merchandise and ratings. SetGA is the diversified hedge, protecting the league's relevance in fashion and high-income demographics. The NBA isn't replacing LeBron with one person. They're replacing him with a conglomerate. If you want to know who the corporate powers have truly selected, do not look at the fan voting returns. Look at the footwear contracts. In the NBA economy, achieving all-star starter status is often the contractual trigger for multi-million-dollar escalators. These clauses incentivize brands like Nike and Adidas to campaign for their athletes like politicians running for office during an election year, creating a proxy war between the manufacturing giants. Currently, there are fewer than 30 active signature shoes in the league. Earning one is effectively the IPO of an athlete's career. Nike is leveraging Wembanyama and his GT Hustle line to maintain its global monopoly. They view his alien brand as the only asset capable of securing the European consumer against rising Chinese competitors. Conversely, Adidas is using Anthony Edwards to disrupt Nike's domestic stranglehold. The viral success of the AE1 campaign proves that Nike's grip on American youth culture is slipping, and Adidas is capitalizing on that weakness by pushing Edwards as the authentic, unfiltered American alternative to Nike's polished corporate image. They are fighting for the soul of the American teenager. Then there is the Converse strategy with Shai Gilgeous-Alexander. This is a niche but brilliant play. They are effectively ignoring on-court performance marketing to focus entirely on the tunnel walk. The Shai 001 isn't being sold on vertical leap statistics, it is being sold on runway appeal. Converse is positioning him not as a competitor to Jordan, but as a competitor to Balenciaga. The harsh reality is that many of these signature lines act as loss leaders. Between R&D, global marketing blitzes, and distribution costs, brands are willing to sacrifice initial profit margins to establish long-term brand equity with the next generation. They are buying loyalty at a premium today to ensure solvency tomorrow, because the lifetime value of a customer hooked on a brand at age 12 is incalculable. The data suggests the league is transitioning from a monarchy ruled by King James to a corporate oligarchy where no single failure can bankrupt the system. The LeBron era of a singular face of the league is financially obsolete. The data proves the NBA's future revenue relies on a decentralized trio, Wembenyama securing the global reach, Edwards locking down US culture, and SGA capturing the lifestyle crossover. The league isn't looking for a savior. They are building a diversified asset portfolio. If you want to understand the real winners of this transition, watch our breakdown of the agent ecosystem next. Subscribe for more.